real estate investing very much is a hands-on approach to real estate investing. Typically, on the active side, your profits over time will be higher. So you're not actually taking a loss. It's a phantom loss, but it benefits you on your taxes. We call that depreciation. Do you have cash sitting around doing nothing? Well, a passive real estate investment might be a good option for you.
We were in negotiations.
Investing in real estate, they're winning, they're making money.
Hey, what's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I am your host, Kevin Amos. Here we are again, another solo episode where I'm going to talk about passive and active real estate investing. What's the difference? What are the benefits? And which one is right for you? I hope you get a ton of value out of the Real Estate Educators Podcast. If you do, hey, give us a 5-star review and maybe share this with a friend, someone who else that you think could benefit from the information we are providing. So what I'm going to talk about today, active versus passive investing. I want to explain the differences, well, what they each are, the differences of each of them. And then we could go into maybe some of the reasons you would want to consider one over the other, or maybe it's both. I mean, it's probably not a bad idea to look at both options because there is benefits to both. So what is active real estate investing? I am going to share some slides here, although it's not super important for you to see what's on the screen. So for those of you in your car, driving down the road, listening in, you really are not missing very much here. But I do want to put up these little slideshow here. So what is active real estate investing? Well, first, I think we need to understand that active real estate investing very much is a hands-on approach to real estate investing. It's very typical what you would think as a real estate investor. So buying a condo, buying a townhome, buying a single family house, renting it out. Maybe you expand and go to larger multifamily or commercial building, but you are the one that owns the building. You're the one operating the building. Now, I say own the building and operate it. It could be that you're operating it without owning all or even any of it. So if you're a sponsor in some type of a group and everyone else is putting in the money and you're just managing it for them, property managers is a great example of this. That's active participation in the real estate investment as well. So anytime that you are the one that's either swinging the hammers or calling a contractor to swing the hammers, doing the administration, that is active investing or active participation. But for the purpose of my podcast here today, active real estate investing is not property management. It is actually owning the property. And then, yes, you probably will be managing it as well, although that could be outsourced. So hands-on approach. Some of the risks here and some of the things that we need to understand as an active real estate investors, real estate's very local. So you could get yourself into trouble not buying a property in the right area. So I'll give you a quick example of this. I was buying up properties like crazy out in Memphis, Tennessee, because I could buy them for $25,000, maybe $30,000, and they were renting for $650, sometimes $700 a month. So on paper, these were actually home run deals. Buying it for 30, renting it for 600 with no HOA. So that is a 2 times rule. You know, we hear about the 1% rule. This is a 2%, right? So we're renting it out for twice what we're paying for it, basically a month. So those are very strong rental numbers. The problem is I didn't know the area so well. So I bought a property on what I'm convinced at this point is the absolute worst street in Memphis. And it was full of gang activity, high crime. My next door neighbor was seriously like the guys from the movie Friday, just sitting out in the middle of the afternoon with their malt beverages, hanging out on the front porch, scaring anybody away that was trying to look at the property to either buy it or rent it. So I ended up taking a pretty significant loss on that deal because I didn't know the area. So if you're an active real estate investor, I think it's important to understand the areas that you're investing in. You have to understand the asset types. So, you know, in real estate, there's many different asset types. You have your single family, your condos, your townhomes. Those are all sort of one one group. We would call that residential real estate. Then you can get into multifamily residential real estate, which for financing actually qualifies as more of a commercial asset. So anything over 4 units, the game totally changes on the financing side. Now, managing a 5 unit compared to a 4 unit, probably the same. I don't know that you would feel a difference there, but it's the money side of why the big difference between 4 and under and 5+ units. So that would be a different asset class. Other classes could be industrial. You have large warehouse industrial, like heavy industrial, they might call it, or you might have the little small bay, 3,000, 2,000, even smaller sometimes industrial bays, which we would call like a flex building or or light industrial. Then you have your medical uses, you have your offices. Obviously, there's land and land development. What am I missing here? Retail. You could have inline centers. You could have, quick service, pads where it's just like a drive-through, quick fast food restaurant type of thing. Those are all different types of asset self-storage. I keep going, don't I? But all of those are different types of asset, and each different type of asset and asset class. And each time you switch, it's completely different, you guys. So you need to understand what exactly you are investing in. You obviously are dealing with the tenants and the toilets and the contractors and the tantrums and the administrative headaches. Sometimes it's going to be regulatory headaches depending on use of the building. For example, you could have a flex space building and it's a flex asset class with a medical marijuana use or something like that. A whole different slew of regulations. Assisted living is a hot topic now. That's a whole different type of regulation. So you need to understand all of that as well. And then you have to have some experience or skill in negotiating leases, negotiating contracts with vendors and contractors, enforcing those contracts, because sometimes you have to do that. And then lining up and making sure all of your financing is in place to take those deals down. So there's quite a lot involved with the active real estate investing piece of it. Sometimes I should say this as well. It's not going to be as much on the passive side. The passive is going to be more cash intensive because you typically aren't using leverage at all or very little leverage, which I'll talk a little bit more about in a minute. But you are going to need some cash and you need some cash reserves. I say this all the time, guys, but profitable business go out of business sometimes. So it doesn't, just because you're profitable on paper doesn't mean that you could withstand hiccups and challenges. You have to have some liquidity, some cash reserves. So make sure you have enough for your down payments and you keep enough in the bank for your cash reserves. So active is hands-on. We talked about that. You property management, you got construction management. You have to go out there and find, locate deals, which can be very challenging, by the way. If anybody out there looking for deals right now knows what I'm talking about, it's not so easy in a tight inventory environment like we're in now. But there are some benefits if you're going to be the active investor. Obviously, you have control. If you own the property, you make the decisions, right? You don't have somebody else managing that for you. So one of the biggest benefits of active real estate investing is control. You get to choose when you sell it, how much you rent it for, which tenants you want. So that is, my opinion, the largest benefit of active investing. Did I say passive earlier? I meant active real estate investing. And then you can minimize fees. So whenever you have a passive approach, somebody's managing it for you. It's going to be like that 100% of the time. So if you have somebody else managing your assets, so it's completely passive for you, there's likely fees. So active investing is limited to no real estate fees. Then you're going to have some bigger profits. And we'll talk about some ways to increase profits on the passive side also, but typically on the active side, your profits over time will be higher because you get to benefit from the appreciation, the tax benefits, the reduction in your mortgage or your debt, and the cash flow if you're buying for cash flow. So lots of different ways to make money as an active real estate investor. And that's why so many real estate investors become millionaires and even bigger than that. It's definitely a wealth builder. But it can be tough. It's a higher risk investment. We talk about that a lot. Like when you own the property, the owner is the one that bears the greatest amount of the risk. So it can be a scary side of the business to be on. Risk is always prevalent in real estate investing. And it can be a little bit scary, right? Because you're the one that's out there on the hook, oftentimes all by yourself. But luckily, there is other options than just buying residential real estate. And I want to be very clear about this. When I get into the passive side, I have an absolute passion for passive real estate investing, but I also have a pretty strong portfolio on the active side too. I think both are important. So I'm not saying one is better than the other, but if you're worried about some of the downside risks and effort that goes into active investing, there is an alternative, and it's passive real estate investing. So there's really two things I want to cover on the passive real estate investing side. Number one is syndications, and then I'm going to talk a little bit about debt. So syndications is where you have a group of investors all come together to buy one larger, typically it's a larger type project. Like we see a lot of multifamily syndications, a lot of the big, um, 100, 150 unit type of apartment buildings are owned by syndications because it's easier for a group of people to come up with a down payment than it is for just one person. So my little graphic here is just a lot of people investing into an LLC with one person managing that LLC. So everybody's giving them money and trusting that the manager of that LLC is doing the right thing. And then they go out there, they identify the project, they pool the money together, put the down payment down, and then they most likely hire managers either on-site or or off-site management. But ultimately, they are the ones managing the managers. So it makes it completely passive for you. And you get to own a piece of a much larger project. So there's a lot of benefits to the syndications. I really like syndications and I invest in them frequently. The key here is to invest with the right group, the right sponsors, someone that's trustworthy, someone that reports well, is transparent, and someone who's a good operator, just like they know how to turn properties around or how to manage them. So I do like syndications. I would not say anything bad about them. Some of the benefits are there's a lot of upside because you are an owner in the building. You're not the only owner like an active investment, but you are an owner. So after fees, which you will have to pay some fees, after fees, you get to keep your portion of any upside. So this is how you get your returns higher on the passive side. But there is some risk, of course, when you're doing that. Now, another benefit is the tax benefits. So just like a single family home where you get those great, fantastic tax benefits, you will also get those same benefits in a syndication. And then you get all the other benefits like the cash flow, the reduction in debt. Obviously, downside, you don't have the control, right? Someone else is making the decisions, and you might love the cash flow, and they say it's time to sell. And although it's nice, you get your little profit. Maybe you don't want to sell because you want to keep that cash flow, for example. So you would not be able to make that decision in most syndications. Now, just be careful that you're only working with experienced investors, someone who knows what they're doing, and be careful with state taxes. So another quick story for you. I invested in a pretty profitable, in fact, most people would say it's a very profitable syndication on a 100-unit building in North Carolina. And we took the bonus depreciation. So we had a whole cost segregation study done so that we could depreciate the asset as quickly as possible. And it was a tremendous first year tax benefit. I showed a gigantic loss from my investment, which is exactly by design. And I was able to write off all of that loss off of other income on other investments and just other income. Well, the problem is when you sell a building and that you depreciated, and I know I'm going a little bit high level here, so bear with me. And if you need some help, give us a call or shoot me an email and I'll help explain this. But whenever you depreciate a property and use that depreciation to benefit on your taxes, you're supposed to recapture, they call it recapture, that depreciation when you sell it. So let's say on a commercial building, it's around a 40-year depreciation schedule on the actual real estate improvement, the building itself. So let's say it's $1 million. So you take $1 million, divide it by 40. This is a very simple way to think of it, by the way, but You divide that by 40 years, and whatever that number is, that's the amount of your deduction every single year, right? So you're not actually taking a loss. It's a phantom loss, but it benefits you on your taxes. We call that depreciation. So if you sell, or when you sell that building, all of that depreciation has to be recaptured. So all we're doing is lowering our basis. And then when you sell it, you pay a gain on what you sold it for minus your basis, right? So you pay a higher amount of taxes when you sell it. Well, the problem for me in my story here is North Carolina. When we sold that building and I had to recapture my taxes, it limited the amount. Well, let me back up. I had to recapture 100% of the depreciation. So I had to pay 100% full taxes. Well, when I got the depreciation benefit, they limited the amount of benefit I could get to like 20% or something, and then it's a carry forward loss. So I was able to carry forward 20% of the tax benefit from the depreciation, but I had to pay 100% of the taxes. So now I have 80% of my loss that I took on that building, that depreciation that I took. 80% of that I could still use in North Carolina, but it's wasted if I never do a deal there again. So I had a limited tax benefit from the depreciation because they limit me on how much I could take. And then I have to pay a full amount on the recapture. So I'm stuck with 80% loss that I can't use. So I'm only sharing that story with you, not because I'm a CPA, because I'm not, but something that you might want to run by your CPA before you invest in a syndication in another state, especially if they're going to be doing a cost segregation study with bonus depreciation. You could find yourself with a little surprise there, but bonus depreciation is super valuable and it is available to you in a syndication. A downside, well, there's several downsides to syndications. One, obviously, being the risk and capital calls. So if the property is not doing as well as you would like, you might have to put more money in. Just like a single family home, if you need to help fund it, which is why I said have reserves. If you have to help fund it, you got to come up with that money and help fund that deal, right? Well, in a syndication, there could be the exact same thing. You got to contribute your portion to whatever is needed for the group to get through whatever hiccup they're in. So we call those capital calls. And if there's a capital call, you have to put money in and you're investing to get money out, right? So it's the exact opposite of what you were expecting. So just a heads up, be careful on capital calls. A lot of syndications require you to be accredited. Accredited is pretty simple. If you have $1 million net worth exclusive of your home, or you make $250,000 a year every year for the last 2, with the expectation that that will continue. Or if you're married, if you have $300,000 a year. And there's some nuances to the accredited status. Like, for example, if you have a securities license, you would be considered accredited, even if you don't meet the financial threshold. So check out the SEC's website or give me a call, shoot me an email, and I'll help to identify if you're accredited or not. When you do a net worth, a lot of people are accredited and they don't know it. So when you do a net worth, and you have to hit $1 million, that everything is included in net worth, any asset that you have. So jewelry in your jewelry box, furniture in your home, the TV hanging on your wall, all of that is an asset. It could be sold for cash. So if you value all of that stuff and include that in your net worth, a lot of people hit that $1 million threshold that don't even necessarily realize it. So just be careful there. You might be accredited and not know it, and then qualify for these syndication investments. So that's the syndication. The other option is debt. That's what we focus in on here at Pine Financial Group. I love investing in debt. The reason I like that is because it's the first position in the capital stack. So if there's any problems and we have to liquidate, the creditors or the lenders, they always get paid back first before the owners. So getting paid first is the position I typically want to be in, because it's, even though you give up some return, you are in a very secure and safe position. So if you're not looking at the screen, if you're at in your car listening in, I have a little photo here made from my GPT friend. They do, so this is an AI generated image that I just said, what does it look like if you have someone loaning somebody else money and you have a little safety net secured by housing. What does it look like? So the picture here is just a safety net that's catching some money. And the reason I wanted that photo in there is because it really is what debt investing is. You have a safety net. You could always fall back on the real estate. So if there's a problem, worst case, you could foreclose and get the property. Now, there's two ways to invest in debt. You can invest directly in loaning somebody else some money. So you have a friend that's doing a fix and flip, you loan them the money to do it, right? You could buy notes. Someone like Pine Financial sell notes. Other hard money lenders sell notes as well. So you could always find notes that you already originated, maybe have a month or two of payment history, and then you just buy it. And then finally, there's mortgage funds, which is very similar to the syndication where you invest in a pool and you have somebody managing that pool. The difference between a syndication and a mortgage fund is the syndication is actually buying real estate. So they're in a higher risk position, potentially higher return. And the mortgage fund is investing in loans secured by typically a senior lien. So it's a lower return, but a much safer position to be in. So it depends what you're looking for. You're looking for much higher return and you're willing to take on some risk, then you'd go a syndication route. If you're looking for, very steady, secure, we don't want to take any losses kind of thing, you probably want to be in more of a mortgage fund, or some people will call that a debt fund. So how do you know what is right for you? So I already covered some of this here, but do you want control? Is it important for you to make the decisions in the investment? If that's the case, you could potentially buy or originate mortgages because you would have complete control there, or you would want to be an active investor in investing in, single family homes or something, just own a rental portfolio. So I know control, it is for me, so I get it. Control is highly important to a lot of investors. Do you have the skill and the confidence to go out there and be an active real estate investor? If not, you can go get it, right? We all start somewhere, but if you're not interested in building up that muscle or that skill, but you want to be involved in real estate, you might want to look at the passive approach. Also on the active side, do you have the ability and the desire to operate, knowing that you're going to be doing the administration, you're going to be paying the bills and the bookkeeping, the record keeping, all of that? Do you have the time and the ability to do that? Are you okay with some risk to maximize returns? Then you definitely want to be on the active side. Active real estate investors will typically make more money. Now there's double-edged sword, right? A downside or in a downturn economically, the owner is the last one to get paid, like I mentioned. So if you're the owner and the only owner, you're bearing all of that risk. So there is a little bit of risk there. So if you're okay with that risk and you're shooting for the higher return, the active is the best approach. Passive, what are some benefits here and why would you want to look at that? If you don't mind taking the back seat and wanting another more experienced, maybe more skillful investor do the work for you, then the passive approach is the way to go. I'm as I say that out loud, I'm thinking like when you hire property managers to manage your real estate, and I have properties that I have professionally managed, and I have properties that we manage ourselves also. And I think there's advantages and disadvantages to both. Now, for us personally, we don't pay management fees on the ones we manage, right? So that's a significant savings. We also care a lot more, so we work harder to make sure our tenants are happy and we're finding good quality tenants. So I think there's a lot of benefit there, but it's more work, right? And are we doing the best we could at keeping up with market rents, doing the increases, and with the heavy regulation, especially in the markets we work, are we staying compliant with all the rules and regulations? I think so, but it's changing so fast and it's so complicated that I don't know for sure. I got to be perfectly transparent here. I think so, but I don't know for sure. But on the property managers, when you have professional property management, you trust that they are doing everything right and keeping you safe. So there's some benefit there as well. On the passive side, back to what I was actually supposed to be talking about. On the passive side, do you have cash sitting around doing nothing? Well, a passive real estate investment might be a good option for you, especially if you're looking for cash flow, because cash flow is hard to get right now on the active side. The active side is more of a long-term play, I believe, but you could definitely get cash flow investing in something like debt, for example. You could get immediate day one cash flow on the passive side? Do you have the time to commit to active investing? And if not, if you're a busy professional and you make your money doing something other than real estate, you just want to invest the money you make for your future, then you probably want to stick to the passive side. If you lack knowledge or expertise, and then in the case of debt, if you're looking for something that is paid first in the capital stack, you want to be on the passive side. So what are you looking for? Chasing returns? Maybe you go active or syndication. You want very stable and secure. Then maybe you want to go, passive debt. So lots of different options. As you can see, there's lots of ways to make money in real estate. But what it comes down to me, what I really think is the most important is this. And if you're looking at the screen, you can see it. If you're not, it is diversification. I personally, and I just did this for a mastermind group that I'm in. We have to disclose all of our financials and our position, and we all break down our investment portfolios. And I had to look. And what I did was I looked at my entire portfolio and I put it into different categories like a pie chart, and how much of my investment is in active real estate investments. So my rental properties, my office building, how much of it is in passive? So how much do I have in real estate debt and my syndication deals? How much of it is in liquidity? So my brokerage accounts that I put my 401k and all of that in that category. What's in crypto? What's in PE, private equity? I've started to get a little bit of exposure to some private equity, and obviously what's in cash. So I break it all down, and what I've noticed is my two biggest pieces of my pie chart, my biggest pie pieces, are active and passive real estate investments. And I'm very, very comfortable with real estate, but I do think you need to be both active and passive to get true diversification. So I guess that's what I wanted to share with you today, the active investing and passive investing, what that is, what that means, what the differences are, and how can you decide what is the best approach for you. If there's anything that we could do here at Pine Financial, please let us know. And I probably should say this. We have clients that are both passive and active, right? Our fix and flippers, the clients that are out there borrowing money from us, the real estate investors, though, they are active investors. They're out there doing real estate transactions, and they do quite well. And the money that we get to invest in them or to loan to them comes from our passive real estate clients. They do quite well as well. But we help both passive investors and active investors. So if there's anything we could do for you, please let us know. We would love to participate in your success. You can get more information about us at pinefinancialgroup.com. Again, that's pinefinancialgroup.com. I hope you enjoy these little solo episodes. I'm having a lot of fun doing it. Have a lot of fun interviewing people as well. So keep checking out the Real Estate Educators podcast. If you haven't yet, please 5-star review and share this with a friend. And I hope you make this day a great one. Thanks, guys. Hey, guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh, yeah, and tell a friend.